A lot of people think about their downside protection, particularly in this market. So I think 7 years is interesting because naturally a deal is de-risked by the debt profile associated with it and the length of time you get on that deal before a capital event needs to happen from term ending or effectively something else of that nature. So just something to think about there. We're typically taking out 5 and 7 year fixed rate debt terms, and debt's been kind of landing between 5.4% to about 6% on the deals we've done so far to this point in the year. But it seems like we're going to get debt sub 5.5%, maybe dare I say 4.8%, just depending on the lender spread associated with the deal. Rob, can you just talk about real briefly while we're on that subject and just glaze over the subject just for a quick second, which is how lender spreads work and what that means. We did have one of our partners who had a question about this at one point, which is lender spread and how our interest rate is comprised. So you'll have the 2 to 10-year treasury note, right? Or amount depending on the day, and then you have a lender spread. So you add those two factors together. But can you explain in a Rob Beardsley fashion way how that is comprised?
Lenders want to make money, and so they have a spread. And so that spread is going to be reflective of the risk of the deal and how competitive the lender is chasing that deal. So obviously bridge loans are riskier than fixed rate loans that are permanent. So a bridge loan is going to have a higher lender spread than a permanent loan.